Hello, everyone. This is Terry with Fuse.io, and as always, I would like to thank you for joining us today. It is my pleasure to welcome Dan Cook from Nadex for today's webinar, Trading for Life. Throughout the webinar, if you have a question, please feel free to type them in the questions box, and we'll do our best to answer them at the end of the event. This webinar will be recorded and posted on Futures.io website within 24 to 48 hours. If you're watching this afterwards on YouTube, please do us a favor and give us a thumbs up if you enjoyed the webinar. And as always, please feel free to share, comment, subscribe to our channel. It really helps us a lot. For trading news, events, and information, follow us on Facebook, YouTube, and Twitter using @Futures.io. And now, without further delay, I'll hand it over to Dan, and you'll get the pop-up again to share your screen.
Oh, thank you, Terry. Can you see my screen all right?
Yes, sir. Looks good. She's all yours.
Oh, fantastic. Well, first of all, I'd like to thank Terry and Mike for having me on. I've been looking forward to this for a while. I've been a big fan of theirs and the website and everything they do for a long time. And I think we'd all agree it's a great forum to ask questions, express opinions, and really bring traders together. So I really want to express my appreciation. So with that, we'll get started. As Terry mentioned, type your questions into the chat box. At the end of the presentation, we'll go through those. No need to take notes or anything. I'm just going to hopefully share some stories with you from my experience. And I call this webinar Trading for Life. And one thing I want you to notice is this isn't trading for a living. Now, many of you may want to do that. Many of you may want it to be your full-time profession to trade. Others, it may be more of a hobby. I've worked with a lot of different types of traders, but whether we're looking for life, and I want to express the term life rather than just a living to me seems like something we do for a time, right? But what we want to focus on, particularly through this presentation, is how do we last for life? Yeah, right? Trading, whether it be a hobby or whether it be for a living, we've always got to look out for those big events and how to mitigate those risks that could take us out one time. And I'll share some of those stories in a little bit. I also call this, and give me 1 second here, the alternative name for this is how to lose money trading. And that might seem odd, right? Who wants to lose money? None of us, but it happens. Most of us get into the market to make money, but I feel like a lot of times we're not prepared as individual traders. Even a lot of the professional traders I know at different firms aren't always prepared for those losses as well as they should be. I often think, when I got into trading, right, it was about making money. Very similarly, when a long time ago, when I was much younger and had more hair, I had studied Aikido because I thought I was going to be the next Steven Seagal. I thought, this is awesome. Aikido, great sport. I'll get in great shape. I'm going to just learn how to be, real badass. And, the first few lessons, all I did was spend about 45 minutes falling down, falling and rolling and falling and rolling and falling and rolling. The reason for that was I had to be prepared because I was going to fall, as I learned a lot. Similarly to trading, right? We have to have that basis. The only successful traders I know all know how to take losses. And that's such an overlooked part of trading, and I can't stress that enough. So with that, let's get going. Before we begin, quick risk disclaimer. Hopefully you all know trading involves risk, whether that be on Nadex or any other exchange, whether you're trading futures, Forex, stocks, binary options, doesn't matter. It involves risk. It should only be risk capital that you ever use. I didn't put that in the presentation because I figured it was a given, but if you're trading with grocery money or trying to, I will guarantee you with 100% certainty you will lose your money. So it always has to be risk capital. Now, one thing you won't notice in this risk disclaimer, which if you trade futures, if you've traded options, Forex, any other type of leveraged product, you'll always see the disclaimer that you can lose more money than you have in your account. I've seen that happen. That, though, can never happen at Nadex. On this exchange, we are designed for the individual trader. We believe traders should have access to the markets, but do it sensibly. So you can never lose more than you put up for a trade. If you trade options, think buying a call, buying a put. It's all defined risk. And I'll get into a little bit on why that's so important to me in my background a little bit. So why am I here? Well, I placed my first trade in 1997. I didn't start trading, though, until about 2001. Probably a lot of you can relate to that. My first 4 or so years during the tech boom, I was placing orders like crazy, thought I was trading, but I wasn't. I didn't know what the hell I was doing. And when that bubble burst in 2000, I got wiped out. That was a very painful time. However, it was one of the best times for learning. And what I learned was I didn't know what the hell I was doing. And thankfully, I had a lot of good friends that after giving me enough hard times and also buying them enough beer, they really helped me out into learning how to trade. They were professional traders. One great thing about Chicago here where I'm located is there is a plethora of people that understand trading and understand the markets from every angle. Got into the industry full time in 2004. So the last 15 years I've spent trading. Time as a trading coach, I've really focused on education over the last 15 years because I really believe it's imperative. I also work on the operations side. I've recently designed a new contract for the exchange, which I'll touch on a little bit. By the way, I'm not going to give anybody a sales pitch today. I work for Nadex. I'm going to show you where you can get some resources, but I just want to focus on trading today. I don't have any special education. If you're looking for a doctor that's studied economics and principles of market or advanced mathematics, that is not me. I grew up basically working on a farm. Can tell you all about raising hogs and cattle and planting corn and baling hay, but I don't have any special education. Where I've been really, and I consider myself very lucky, is in two facets. Through my work, I've been able to meet a lot of great traders. People that I've traded with them, they've taught me lessons. I've had some great mentors. Great thing about trading is it's a never-ending process of learning. But also, and this might seem a little bit odd, I've had the opportunity to literally watch hundreds of thousands of traders fail. As a trading coach, I worked with individuals specifically, but having worked at brokerage firms and having worked, basically across the industry, almost exclusively with individual traders, I have spent some time working with institutions as well. But my passion's really been working with people that are individual traders, people really like me. And I've learned a lot from how traders fail, and the same patterns emerge time after time after time after time. It seems to go on and on. And one of the things, I've seen the same things in myself, and I still have to correct these. It's a never-ending process, right? We continue to learn. We continue to have to learn about ourselves. We often talk about psychology of trading. That psychology gets a whole lot easier. So what I want to share with you today are the patterns that I've seen on the main reasons why traders lose money. And it can really be boiled down to, 5 to 7 pretty big topics, but things that if we control, we stand a lot better chance of having long-term success. That's what we're going to talk about today. And actually, I happened to catch, I don't know if everybody else caught the poll yesterday. This was actually perfect timing because a lot of these things are what we're going to be talking about. Hopefully this will be a bit entertaining, but also educational. If you take away a couple of things from this, that's fantastic because I found sometimes the smallest things in my trading had some of the biggest impact. While I've already mentioned I learned a lot from great traders, I've also learned a lot from those that were absolutely new to trading that maybe just had an idea or asked a question. And I really want to share and give back because I've had the opportunity to work with all different levels of traders, but not following my own rules, over trading, cutting profits short, letting losers run, all of these things are things we deal with on a daily basis. And so let's get into talking about those, but I just thought it was extremely timely. And I don't know, maybe at the end of the presentation, Terry, I don't know if you guys have the results from that. I didn't have a chance to check them out, but I'd be very interested to see what those were. So with that, we're going to talk about how traders lose money, the main reasons that I've seen over the years. Obviously, this is not exhaustive. There can be a lot of different ways, but they all boil down typically to just a few things. And the one I always start with is that they don't have a trading plan. And this, I've had this debate and topic with a lot of traders. Some traders say, and these are successful traders, they're like, oh, well, you can't have a plan. That's just not how it works. And through these discussions, though, I've really kind of honed in and working with traders on what the plan should be and what it shouldn't be. So one thing I'm convinced of, the only successful traders I know all have a plan of some type. So what should it be? It should be simple, right? Why are you trading? And again, if you're going to answer that question as to make money, that is an absolute cop-out. You're doing yourself a disservice. It needs to be written down. This is a business, right? Even if it's a hobby, even if it's not something you're doing full time, but it is a business. And you need to put your best foot forward. You need to do it for yourself. You need to have goals, and those need to be real. If you have a goal that's not quantifiable, it's not a goal. Now, will you always hit the goals? Nope. But just by the simple act of writing them down, and this isn't just trading, this is every aspect of life. I'm a big lists person. Write them down. What is your goal? Maybe you're trading because you want some supplemental income to take a vacation. Maybe you're trading, I don't know, to get out of debt. One note on that, if you're deep in debt, you might want to stop trading and focus on that debt. Goes back to that grocery money thing, right? Maybe it's a lifestyle. I don't care what that is, but write it down, make it real, and make it tangible. By the way, don't do your plan when you're sitting in front of your screen trading, all right? Because then you're just going to adjust it to however you're trading, right? In your plan, you should have risk management. How much of my overall capital am I going to risk on a trade? What's my maximum drawdown every day? Things like that. Have risk management. I'm a huge proponent, for those of you that have heard me speak before, and I'll talk a little bit more about it later, but risk management to me is huge. You know, what's my percent of allocation on any particular trade? What am I trading? Am I trading stocks? Am I utilizing leverage? Keep it simple though. This shouldn't be more than a couple of pages, but what you want to do is make it real, because this plan also will help keep you on track from some of the things we're going to be talking about, and a lot of the other elements we're going to be talking about here should go into your plan as well. And here's another one we're going to touch on a lot in just a bit, but a plan for starting and stopping trading, right? We're going to take a look at, how do we assess our account growth? Where do we take more money out? This should all be in the plan. What it shouldn't be, and this is a big one. I'll tell you, I was a trading coach for several years, and I've worked with traders for years, and trading plan was always my first education module. We're going to work together to develop a trading plan. It has to be unique to you, so that should be in the what should it be. It has to be unique to you. It can't be anybody else's. It won't work if it's somebody else's. It has to be very personal. But it shouldn't be exhaustive. And what I mean by that is I've seen trading plans. I actually had, when I was teaching this class, I had this guy that he went through the course like 6 or 7 times. It took him like 8 months to send me his trading plan, and I kept asking for it, and he's like, oh yeah, I'm working on it. I'm thinking, this is just a 2 or 3 page document. Whatever. He sent me a plan that was over 180 pages. It had contingencies on contingencies. It said what he was going to trade, and if the market did this, then he was going to do this, but if it did this, then he would do this. But if the cat walked across his keyboard and did this, then he would do this. It couldn't be followed. That's why it needs to be simple. This should be a basic set of rules, or I should say guidelines, right? Because it's not a static document. This will evolve with your trading, right? It should be a groundwork, though, for you. It should be a set of guidelines, and rules, guidelines. I'm going to say actually some of it should be rules, meaning if your rule is you're not going to risk more than 2% of your capital on any given trade, that should be a set rule. Certain things like guidelines, maybe what could be a good guideline? I thought when I got to 15,000 I was going to take 2,500 out, but geez, I had a really good runner. It's at 16,000 now, so it's a little bit flexible. But it will evolve. It will continue to evolve. So first things first, take a little bit of time. Think about it. Really think about the reasons why you're trading, because it will help in every other facet of your trading, particularly when we're talking about risk management, fear and greed, and things like that. So when traders lose money, they either don't have a trading plan or they just have a bad plan, right? They also don't plan for every trade, right? So we all know entries, right? What's our entry? Where are our exits, right? Where do we exit on losses? Where do we exit on profits? Now, this might all seem remedial, but I can guarantee you if you traded more than 15 minutes, we've all been there. We haven't always followed our rules, but we need to have a plan on every trade. We have to have our targets also set. We might not just have one exit for a trade. If we're trading multiple positions, we might have 2, 3, 4 profit targets. So you have to understand that plan. And I don't know if anybody's ever seen it. There's an older movie called Ronin with Robert De Niro. And the opening scene is one of my favorites because I think it relates a lot to trading, even though it has nothing at all to do with trading. But basically, Robert De Niro walks into this restaurant. This organization has set a meet for all of these people that didn't know each other. Robert De Niro walks in the front door. A few other people walk in the front door. They're sitting down at the table talking. Lady comes in the back door. She's like, all right, let's go. They all walk out the back door towards this van. De Niro reaches behind a box, the back door, and pulls out a gun. Guy looks at him and basically says, where'd you get that? And his comment was, I never walk into any room I don't know how to walk out of. That is absolutely essential to trading. If you're getting into a trade and you don't know how you're going to get out of it, you've already lost the battle. It just can't happen where you're going to be successful without having that plan. And you need to stick to it, right? If you're going to do your entry, where are your exits? Now, you might use a trailing stop, right? That's going to be adjusted, but hopefully that's all for we're locking in more profit. It's kind of funny. We've got some younger kids here in the office, and at my advanced years, a lot of people I consider younger kids, but a lot of them have just started trading. And I was having a drink after work the other night, just sitting at the bar, kind of decompressing, and they walk in and they're showing me their mobile phone app, and they were like, what should we do here? They were down like $500 in their position. I was like, well, what do you mean, what should you do here? Well, they're like, oh, is it going to 80 cents or is it going to 40? They were trading a penny stock. And I was like, I don't know, I don't care. I was like, what was your plan? And they just didn't have any. And I was like, okay, so what's your plan now? Where do you cut your losses? Without that, without understanding those essentials, you can never be successful at trading. There should always be that plan. Otherwise, you're just lost. The market will do what the market will do. Have that. Know your course, right? If you're going to take a trip, I mean, I often think people spend more time planning their next vacation than their future. A lot of times they spend more time planning vacation than what they do their trading life. And plan every trade. No excuses. No excuses not to. There are all sorts of advanced order types. You can do lots of different things, but entries, they say, can be tough. I think the exits are actually even tougher. The next way I see traders lose their money is they don't define risk. They get into markets where they're over-levered or underfunded. They think that a stop can actually really protect them, and we're going to take a little quiz here in a second. And they think it can't happen to them. If you remember during the risk disclosure, I mentioned if you're trading leveraged markets, particularly, you can lose a lot more money than you ever expected, right? And I've seen it in forums. People say, "Hey, I've got $2,000 in my account. I want to trade the ES, which is the E-mini S&P." Good luck. I mean, you can get day trading margin of $500, but you got a couple grand. If you're, even putting, a few point stop on, you're already down $150, maybe 200 if it's 4 points, right? At $50 a point. Just because you can trade it doesn't mean you should. I've had people say, "Oh, geez, I've got $10,000. I want to go trade oil." Oil's $1,000 a point, right? What are you going to do? You're going to be wiped out of that market. And so I've seen this, though, even in professionals. I've seen this from institutional level investors and institutions themselves, where they don't define their risk, right? They don't understand it. So I'm going to ask a quick question here. Now, I won't be able to see the answer, so I'm just going to walk through it. So this is actually just a screenshot from earlier today, and sorry, it kind of got cut off there on the price level. But so let's just say this is the currency market. Typical leverage for currency market in the US is 50 to 1. But this could be any leverage market. If you're trading oil, you're trading the ES, right? You're getting leverage. If you're trading options in some strategies, right? You're employing leverage. But for example, just to understand risk on this position, by the way, a standard contract, if you don't trade currencies, is 100,000. In this case, it's the Euro USD. It's 100,000 euros, which is now trading at 113.33. So let's just say this was the trade setup, right? I've got my buy order in, I've got my stop. My stop is 40 pips or ticks lower with a value of $10 per tick. So how much is my risk, right? And unfortunately, I won't be able to see the questions or the answers, but I'll just let you know, because most people, and I've done this in presentations, will say, well, it's 40 times 10, it's $400. That's my risk, maybe a little bit of slippage. Your risk technically on this position is $113,000. If you're trading 100,000 euros, right? At 113, $113,000. Now you might say, oh, that's far-fetched. Like it'll never go to zero. Oil won't go from 55 to zero, right? That's not really my risk. The ES won't drop from 2,900 down to zero. That's true, but they can drop really fast. And I'll give you an example. It was about 2.5 years ago where the Swiss National Bank decided to pull the peg from the euro, and the currency markets moved about 40%. Somebody that had this trade on in like the euro Swissy pair, at a 400 pip stop, or $400 stop, right? They thought they were safe. They thought they were doing that. They would have lost on one contract around $30,000. That's real money, right? Now, when we talk about trading for life, what we're looking at is mitigating what we used to call black swans, but actually they're not even so much black swans, they're fairly common. I've seen at least over the last 15 years, I've seen at least 4 events, and I'm not even talking about the flash crash. I've seen 4 events where traders have lost so substantially more than what they ever expected to lose, where they were knocked out of trading. One day in 2007, I came into the market. It was the first I'd ever heard of the upcoming impending credit crisis. Intervention, non-announced intervention from 4 central banks. At the time, the ECB, the Bank of England, and the US Fed put $100 billion of liquidity into their markets. At the same time, the Bank of Japan pulled out, it was several trillion yen. Supply and demand, what happened? We saw about 1,000 pips / tick move on one currency pair. That day, I believe it was 10 or 15,000 traders at just the small firm I was at, margined out. Actually, not just margined out, but all, for the most part, lost more than they had in their accounts to begin with. That's what understanding risk is. Another one, again, I won't be able to see responses, but I've done this. I speak a lot at options groups. I had a options presentation last week. Covered call strategies are a big strategy. People love them. I understand them. They're great. I implement them. But I'll often ask, I'll say, okay, I was talking to a group. It was about 400 or 500 options traders over the summer, last summer, and said, okay, who here does covered call? And it was about 80%, I guess, of the hands went up, and they were all doing covered call strategies. Great for them. So I asked them, okay, how many are selling naked puts? And virtually every hand except for a couple went down. And when I asked why, I asked a few people why they weren't doing naked puts as opposed to covered calls, and their answer was, well, it's way too risky. Here's the thing. The risk profile of a covered call strategy is virtually identical to that of a naked put. I'll just walk through an example. If you're not an options trader, don't worry about this. If you are, you'll get this right away. Let's say I buy a stock for $10, right? So I put $10 into the stock. I do one covered call. I sell a call $1 out of the money for $1. So my risk then, right, is the $10 stock minus the $1 I received for that call. So my risk is $9. If I sell, right, a call at $9, what's the worst case scenario? It goes to zero, right? I can lose my $9 less whatever I received for it. So let's say I sell a $10 call, or excuse me, a $10 put, and I get $1 for it. My risk, $9. It's the same. So that's about understanding risk. By the way, also when Swiss National Bank pulled that peg, huge firms collapsed, not just individual traders. It was a massive crush, absolutely massive. There was a firm that was probably $250, $300 million publicly traded, went under in about 12 minutes. It happens fast. And so going back, we have to define our risk. That's one of the things, as I mentioned in the disclaimer, since I've been at Nadex, and this has been since 2011, I've never had to make a margin call because nobody can go deficit in their account. It's no guarantee that you'll be successful, but when I look at these, when we consider trading for the long term and trading for life, if we're not looking at our position sizing, remember that's one of the things that we need to look at, position sizing, how much leverage we're utilizing, what the actual absolute risk is on our position. There will be an event, in all likelihood, if we're planning on trading for the next 10 or 20 years, we don't want to be in a position where there's one event that can take us out of the market. I'll give you one other example. There's a firm called Calabios, and a guy was selling calls on it. It was a dog stock. It was trading at about $2. It was just taking a beating, dive, 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 dive. This guy's selling calls for pennies. Well, all of a sudden, buyout rumor. After market hours, it went from $2, I believe, to 16 or 18, somewhere in that neighborhood. You know what that was? Margin call. His $30,000 account went deficit $130,000. You can look up the MarketWatch article. Just look up Calabios MarketWatch. You can read the full article there. He actually started a GoFundMe page to try to cover his losses to his for his account. The comments on that alone are worth the read because the traders were not very nice. So defining our risk is absolutely essential. If you're trading options or options on futures, right? There are a lot of strategies. You can do spreads. You can buy a call, buy a put. A lot of times credit spreads, debit spreads are great. Different strategies where you can utilize the benefits of leverage, but you know with 100% certainty that no matter what happens in the world, you're protected. You're not going to blow out. I've known so many good traders, I'm doing air quotes right now, that were successful for even years. That because they still didn't define their risk, they just blew out. And this goes to the next things. Trading stupid. This is me to a T, by the way. This isn't an insult to anybody, but I'm sure we've all done it. We've all been there. What do I mean by trading stupid? We're looking for a roller coaster ride. We're not even paying attention to position sizing versus our funding, right? We talked a little bit about oil, right? If I have $10,000 and I'm trading a contract that's $1,000 per point, I'm going to lose my money. I'm going to be knocked out of that market very quickly. Another one I mentioned, we have some newer traders. They were asking me, same guys actually were asking me about this position they had on. And so I was like, okay, what's your risk? And they're like, well, what do you mean? And it's like, well, what's the tick value of this particular market? And I already knew what it was. And their comment was, why are you trying to confuse us? These are basics that you need to know. Hopefully everybody on this call, and that's one of the things that I love about this group here, Futures.io, we've got the whole gamut of traders. We've got people with some great experience. So some of this might seem a bit remedial. I know we also have some newer people, right? They're looking for advice. Understand the markets you're trading. Understand the position size to funding. Now, one thing my mentor told me, one of my good friends and a mentor who'd been trading about 25 years at that point, he told me that you can never be successful trading only one contract. You have to trade multiples of contracts. And we'll talk a little bit about scaling up and how we do that in a little bit, but understanding position sizing. So if I was trading, let's say, well, now there's micro futures out. I don't know if anybody's dabbled in those yet. There's micro futures. If you're looking more for a micro contract, I actually launched a contract earlier this year called a touch bracket. I'll talk about that in just a minute, but you can trade different sizes. So instead of trading, before there were micros, if you wanted to trade the big S&P 500 contract, you could do that, right? And if maybe you had enough capital to trade one of those, it might be better to actually go trade 10 of the E-mini S&P, right? Because you have a lot more flexibility. When you're taking profit and when you're looking at those plans, right? If you have 10 contracts on, and same thing with currencies, if you're trading currencies, instead of trading one standard contract of a currency, trade 10 minis, right? And then if you get a position that runs in your favor, and his point on this, on position sizing and not trading just one contract, was that you never know when a runner is going to come, right? So, but if you have one contract on, it hits your profit target, you're out of the trade. What if right after that, all of a sudden the market takes off in your favor? I much prefer to be able to take profit on one contract, and if I'm trading multiple contracts, maybe the other ones can run. Maybe I give a little back on them. Maybe the market reverses and I hits my stop. I've locked in a little bit of profit. That's fine, but always think about your position sizing in that. Never chase losses. No revenge trading. God, the term "beat the market" I kind of hate. Right? We all want to outperform the market. I'll live with that. But when we say beat the market, I'd rather work with the market. I'd rather let the market's always going to be right. We only can be right, percentage of the time. We don't want to chase those losses, right? If we're wrong, be wrong. Get out. Another thing a good mentor of mine said, the only difference between him and a newer trader was that he got out of his losses faster, right? This is always a catch-22, like so many things in trading, because I always make that comment, and then you see people smother the market with stops, and they keep getting stopped out, right? You have to assume some risk, but if you take that loss, take it and move on, right? You don't need to revenge trade. You don't need to chase those losses. It's so much more difficult, and this goes to position sizing and kind of that fear, right? We talk about fear and greed in the market. If you're over positioned, right, and you're taking on too much risk, that's where the market gets very exciting, not always to the good thing. If you think trading should be exciting, you're absolutely doing it wrong. If you're placing a trade and your heart is racing and your palms are sweating, no way can you be successful in that, right? It's not a roller coaster. That means you're probably taking on too much risk. I've seen it so many times. People think they need to be in the market, right? It's that over trading, that third bullet point there. They're over trading, right? I'm a trader, I got to trade. Cash is a position, right? It does not have to be in a trade all of the time. You need to be patient. I swear sometimes I think people, hear bells ringing and they're picturing the pits and all the excitement and all the stuff that went along with that. Cash is a position. Be patient. Let the market come to you. The market will be here for the rest of our lives, right? You don't have to get into a trade every second of every day. I work a lot. We're open about 23 hours a day. And one of the things I like about that, people can trade, but I'll often have conversations with them because, maybe they trade at night. Maybe they're trading at 10 p.m. To 11 p.m. because that's after they've put the kids to bed, they've done dinner, that's when they have a chance to look at the markets. They want to put some trades on. What happens is, though, I see them compress that window of 1 hour because they want to get in there and trade. They compress that window and they're chasing the market. They're trying to make opportunities instead of trying to find the opportunities that are there. And if there are no opportunities, step away. Don't have to even place a trade every day. I do a lot of some live trading over the years in front of like coworkers, like talking about the markets. I'm not allowed to anymore because of rules working for an exchange, and I have to be unbiased. I'm not allowed to live trade in front of anybody anymore, but that used to be my every night of the week I would trade currencies live in front of a group of people. Sometimes I never placed a trade, and they would be like, well, why aren't you trading? Well, because you need to be patient. It's a very important lesson. Hopefully not beating it too much. By the way, trading can be fun. It should never be exciting, but it can be fun. It should be, you should have a method, right? It should be pretty well thought out. Not boring by any means. It can still be fun. It can still be enjoyable. I mean, the market's always going to test us, right? But we don't need that heart racing. I'll tell you one quick story. He's a good friend of mine. His name is Jim. He traded on the floor for quite a number of years. Very successful on the floor. He's still in the industry, but when he went to the screen, he had a really tough transition. When I say went to the screen, basically, from the floor where we had the active pits and lots of yelling and screaming and things going on. And he tried to get to the screen, and he just kept trading stupid. And by trading stupid, I don't mean placing a losing trade. I mean, it's when we break our rules. That's when we're trading stupid. And he had a huge issue with this. He blames it on his stubbornness. And I'm going to disclose, I'm not advocating this for anybody, but this worked for him. He was in the office, and he knew he had this problem. He was just bleeding cash. He actually went out and he bought one of those shock collars. You see them for dogs. He went out and got one of those shock collars, and he strapped it to his leg. He came into the office and he strapped it to his leg. And his deal was, at first he was going to give somebody else the push button control, but wisely he decided not to do that because he would have just been on the floor in seconds. But his deal was, and he was a very active trader, if he placed a stupid trade, right? Not one that lost money, but a stupid trade. He took on too much size, took on too much risk, didn't have a reason for it, right? There should always be a reason while you're trading, that he would shock himself, right? If he traded stupid, he would shock himself. And if he did it, shocked himself once, he would turn it up to 2, right? There's a dial on it. In this case, it went from 1 to 10. He would turn it up to 2 and repeat the process, turn it up to 3, repeat the process. And so, he's trading along and, looking at the screen, and all of a sudden you hear, damn it. And so he's like, shocks himself. And he's like, oh, that really stung. Okay, turn it up to 2. That hurt pretty bad. What he didn't realize, and I had never known this, I'll take his word for it, but is that uh, the shock collar actually goes up exponential in power. It's not just a tick, 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 right? If 1 to 2 is a substantial difference, 2 to 3. Anyway, so he's trading along, and all of a sudden you hear, oh, geez. And so everybody kind of peeks their heads up over their cubicle, and we're like, okay, go ahead, Jim. He's sitting there, and he shocks himself, and he kind of jumps out of his chair, and he's like, oh, geez, and he's rubbing his leg. He's like, that really hurt. That really hurt. And so now everybody's kind of gathering around because, we're kind of masochists as traders, or at least we sometimes relish in other people's pain. I don't know if anybody on the call was ever in the pits or has even taken a tour when the pits were really active. And you could actually see somebody physically sweating when they're negative. Trust me, nobody was rooting for you at that time. Sometimes people would help you out, had good guys, but nobody's actually on your side. So as traders, we were all kind of thinking, okay, this is going to be awesome. So he turns it up to 3, and now he's kind of actually like shaking a little bit, but he hasn't stopped trading. So he's going along, and all of a sudden it's like, oh, geez, oh, geez. And he couldn't help himself. He had to trade stupid. So we're like, oh, come on, Jim. Come on, push that button, Jim. And he does, and he flies out of his chair. And he is like rolling on the ground in pain. He actually made a comment later, once he could catch his breath, that it was a good thing he'd already had kids because he wasn't sure he could at that point. Apparently it was pretty brutal. And so he sits back down in front of his screen, and he's physically sweating at this point, and he's holding the button, and he's just looking at the screen, and we're all thinking, okay, he's turned it up to 4. This is going to be crazy. And he's literally visibly shaken, and he's just staring at the screen, and we're like, come on, push that button, come on, make a trade. And shuts down his computer, takes the thing off his leg, and walks away. He claims to this day that he still has not, that he follows his rules. And I've been to the office. We don't work together, but I've been to the office, and he still has that shock collar as a reminder sitting right on his desk. Again, I'm not advocating that. That's an extreme measure in my opinion. Hopefully we can all just work with our own mental discipline and not have to go there. But that's what he did to wreck himself. That's how ingrained this can be in us, is trading stupid, right? We can be very stubborn people at times, right? So always be mindful of that. Have rules. These rules might be updated as you go along, but always have a set amount of rules, right? So let's get into the next one, right? Because we all want to be right, right? There is a huge need to be right, right? You're wrong and that's bad. We think it's a bad thing, right? We have egos, right? Right? I can't possibly be wrong. I mean, this is being wrong. I swear, and I've seen this so many times with traders. They move their stops, right? All of a sudden, the market's moving against them, and they're moving their stop down. It's going to turn, and all of a sudden, they're like hoping it's going to turn, and then they keep moving their stop, or they just pull it, or they had a mental stop. They don't follow their plan. And now all of a sudden it's a big loss. And now instead of a day trade, it's turned into a swing trade for no reason, because it was just a short-term trade that went bad and they couldn't dig it out. And all of a sudden they're really wrong, and now it's too late. It's not about being right. It is about being profitable at the end of the day. Always keep that in mind. Some of the best traders I know, they might be right 15, 20% of the time. They might be profitable on a trade, but they manage their risk really well, and they manage their upside opportunity when they're trading. That's the only difference, right? They want to be right. I'll give you another example. This is one of my favorite stories on somebody who wanted to be right. And this was a guy that I worked with who, claimed to be a trader. I'll give an example on why. Let's just say he placed a lot of trades. So I used to sit in my office, and I was analyzing the markets all day, and I would just call out my trades. I used to do like the Bloomberg CNBC circuit, and I was looking at the markets all day, and of course trading. So I just call out trades from my office because we had 4 or 5 people gathered around, and we were just trading. And so I remember this one particular one. This was when I was at the currency firm, and just called out of my office. I was like, Euro USD short, I believe it was 3 contracts, short 3 contracts at 126.70, 35 pip stop. Right, that was a trade. And as a lot of my trades went, about 2 minutes later, if that, I was stopped out of the trade. It was like I got into this docile market, and all of a sudden the lions roared. Market shot up, took out my short position, and I was out of the trade. I walk out of the office and I was like, oh, okay, well, too bad. We'll get them next time. There's plenty more trades there. And so I look at him and he goes, oh, I'm still in. Like, okay, oh, where's your stop? And he's like, oh, I have a mental stop on. Right. So this was supposed to be, by the way, most of my trades were between 40 minutes to an hour and a half. Oftentimes they were about 30 seconds when I got stopped out to 2 minutes. But if I was in a position, typically it was, a definite day trade. If the market really went in my favor, I had a few that went days. I think the longest trade, actual trade, not investment, but trade I was in, particularly in currencies, was 14 days. Most of my trades, if it's 30 minutes an hour, it's pretty short term. And that's what this was meant to be, was a really quick day trade. Thought we'd get a market move, and it did move just against us. So anyway, he's like, oh yeah, no, I'm still in. I've got a mental stop. And I was like, okay, where's your mental stop? And he's like, oh, well, I'm going to see what the market does. So he didn't even really have even a mental stop. Oh, market's moving against him. Come in a couple days later, and he's got his platform open, and he's still in the trade. And the market's now moved about 200 ticks against us. And I'm like, okay, and so I was like, well, what's going on with that position you got there? And I was like, that was a short-term trade. He's like, oh, no, this was a swing trade. This was a swing trade. I'm taking on the extra risk because I want to let it work for several days. So, okay, so swing trade. He's in this position for a total of 6 weeks. So about 4 weeks in, he's got his position open. I don't know how many other trades I've placed at this time. He just had his capital locked up. The market is now at about 132, right? It is 132 and change. It is about 600 ticks against us at 30 bucks. 30 bucks a tick. So he is down big, right? He's down about $18,000 at this point on what should have been a short-term trade. And he is about, I look at his account balance, and he is about 20 ticks from just getting margined out. By margined out, I mean the broker's going to pull his position because he no longer has the margin to support it. And I'm like, what's going on? And I was like, what are you doing? What is this? And he's like, oh, this was just a punt, right? He couldn't admit to being wrong on the short-term trade, so he changed it to a swing trade. He couldn't admit to being wrong on a swing trade, so now it's a punt. Now he doesn't care about it, right? He's going to lose his 18,000 and change or whatever just because he doesn't want to be wrong. Now, kind of the funny part about the story, so over the next week and a half, the market actually starts dropping, and it drops. And my original position, I believe, was 126.70. The market drops. It actually goes past his entry, and it goes to about 126.50 and change, 126.60, and he takes profit on the 3 contracts for 300 bucks. It was like 10 ticks. And he could not wait to tell me that he was right, how he knew that was going to work out. If you're trading like that, and again, this might be an extreme example, but if you're trading like that, right, don't worry about being right. It's about being profitable, right? Again, you don't even have to be right half the time as long as you're managing your risk to be a successful trader. I don't know how many conversations I've had and how many people I still hear, and we'll talk about it in a second, say, oh, well, I'm right this % of the time. I don't care. We're going to talk about some key ratios. One other thing on that, the best swing traders I know, and they would even admit this, no trade sets up as a swing trade. They're swing traders because they can manage positions really well, right? So if they're wrong, they get out. The market will determine if it becomes a swing trade, right? They're not swing traders because they take on so much more additional risk. They're swing traders because they're great trade managers. All right, not understanding the key ratios, and this kind of goes to what we were just talking about. I even hear it from people in the industry. They're like, oh yeah, I have the system. It's right 90% of the time. I don't care. Don't even give me that. There are 2 key ratios that you need to understand as a trader. Hopefully we all know what these are, right? What are our total trades? How many were profitable and how many lost money, right? It doesn't stop there though, okay? Because it goes back to not being right about being profitable, which we'll talk about in a second. So I'm going to give you an example. Actually, let's talk about the total trades. What's our average profit versus our average loss, right? So if we placed 100 trades, let's say we had 50 trades that were profitable and 50 trades that lost money. If we made $10 on those that were profitable on average, but lost $50 on our losses, we're underwater. Even if we're right, let's say we had 70 or 75 trades that made money, but we made 10 bucks on each, and the remainder we lost $80, right? We're going to be underwater. So we need to understand our average profit and average loss and how it relates to those. And this should be post-trade, right? You can set up a trade however you want. Everybody will say, oh, set it up 2-to-1 risk reward. Oh, who cares? That doesn't matter. Just because you set up a trade at 2-to-1 risk reward doesn't mean the market's going to give it to you. Sometimes you might get 1.2-to-1. Sometimes you actually might actually have a risk reward ratio that's inverse, but you have a high percentage of profitable trades, right? These numbers, though, can't be exclusive of each other. You have to know them both. I'll give you an example, because I've had this phone call. I can't even count how many hundreds of times. We'll call him Joe. Joe put in $5,000 into his account. A couple weeks later, I'll look at Joe's account, and he's like down to like $3,000. And I'll call Joe up, and he's happy as can be. And I'm confused, because I'm like, hey, Joe, how's it going? Joe's like, oh, hey, Dan, great to hear from you. Oh, it's fantastic. I'm right 70% of the time. I've just got to make a couple of adjustments, and I'm really going to be there. And I'm like, no, Joe, you're bleeding cash. It doesn't matter how often you're right? How often your trades are profitable if you're not controlling your risk, because he's bleeding cash. He's excited, which always kind of confused me. He's excited because he thinks he just has a small thing, but he's not actually looking at the whole equation, right? So you can have an inverse risk reward ratio if you have some type of strategy that's X% profitable, but you can also have a low percentage of profitable trades as long as your average profit far outweighs your average loss on a post-trade basis. So understand those two key ratios, and you'll go pretty far. This is the one. Losing traders think the strategy is the key, right? Strategy is important. I will, I'll say that. You have to be familiar with your strategy. You have to understand it inside and out. You have to be able to do it consistently, which we'll talk about, but it is no good without risk management. I remember when I first started actually trading. This was after I blew out my account and I first started, and I was getting serious, and I was like, okay, all I wanted to know was a strategy. And I hear it all the time in my years on the phones. First thing people want to know, they want to know a strategy. And I often thought, God, if I could just find out what the institutions are doing, what time frame are they using? What indicators? I could be successful at this. What I've learned over the years is it doesn't matter if you don't have risk management. So instead of focusing just on that strategy, now again, I'll say it's important to have a strategy. You need to have a defined set of rules for entries and exits. You have to have risk management, and here's an example of that. By the way, I've taken this before with people in the office. I've said, you know what? I'll just do it randomly without even analyzing the market. We'll just do it 10 times. We'll do 10 trades, buy orders. I think with proper risk management, you can come out at least a little bit ahead. Doesn't matter what the strategy is. I'm not even going to do anything with the strategy. And yes, with risk management, I've proven over and over that you can at least be around break even, if not make a little bit of money, right? It all goes back. I think it was Amos Hofstadter said, take care of your losses and the profits take care of themselves. But this was something that was really impactful to me. It was an article in a magazine, 2005, 2006. And what they did as a test, they took four people. They took 2 professional traders and 2 new traders, right? And they paired them up. So you had one professional with 1 new trader, and by new trader, I mean they were trading less than a year. 1 professional, 1 new. The other team was 1 professional, 1 new. They were using the same strategy. They were all utilizing the exact same strategy. And the deal was, for a month, they could trade 1 instrument. In this case, it was a currency pair. 1 team could only be long, and 1 team could only be short, right, for a month. At the end of the month, what they found, using the identical strategy, the same instrument, 1 team only long, the other team only short, the 2 professional traders had both made money. There was a little bit of skew in how much each made, but they both made money. Both newer traders lost money, utilizing the exact same strategy. It's all about that risk management and understanding risk. And that's what they discovered. There was no difference. But and we looked at that poll earlier, the newer traders, the less experienced, let their losses run and often took profits way too quickly, or, which we'll talk about in a minute, didn't lock in profits. Another thing that just bugs the crap out of me. You watch the market fly, and I've had that conversation too. You watch the market fly, and they're like, oh, so excited, and the fear and the greed kicks in, and no profit is taken, and then the market comes back, and they're right about, maybe even lost some money, or they're, gave back all their profit, right? So strategy is important. You need to be able to do it consistent, which is another way people lose money, is no consistency. They pinball all over the place, searching for the next thing, jump from one strategy or market to the next. They read an indicator. Trust me, this looks like one of my old charts, thinking, oh, geez, if I just add these indicators and I'd read this one and I'd try to do it. The best traders I know keep it very simple. They can replicate it over and over and over. If you're getting into options, if you're trading options or any trading, really keep it simple. But one thing, my experience in options was great, right? I learned what a call was. I learned what a put was. I learned the Greeks. I knew what delta, gamma, all of those, everything, great. And then somebody was throwing out, oh, you need to do a long iron condor, double leg, triple X, inverse 2x1, whatever. Confused the hell out of me, and I couldn't keep it simple. And if you can keep it simple and do something consistently, right? If you look at, if you watch golf, right? Golfer gets up to the tee. They do virtually the identical thing every time. It's like mental preparation, right? Maybe they have 2 waggles of the club, then they tap it twice, and then they get up, take their tee shot. Same thing if you watch baseball, right? The batters are typically getting in, addressing the batter's box, exactly the same. Same with trading. Be consistent. So how do you stay consistent, right? One is to keep it simple, right? It has to be able to be replicated, whatever that is. The next, and if you take anything from this today, take note of this slide. Losing traders don't track their trades, right? And I don't mean that you have to sit there with an Excel sheet. I'm gonna show you actually how to be a better trader with 3 magic keys and $10, right? But you have to track your trades. And I know some people really love Excel. I know some traders that just get all geeked out over it and love it, and they've got everything written down. That's not for me. So here's how to be a better trader. And this all goes to learning from your losses, right? You've got keys on your keyboard, right? You've got your chart up. This is particularly true for technical traders, right? You hold down Control and Alt, and you hit print screen. That's it. It's as easy as that. It takes a snapshot of your screen. So if you're a technical trader, maybe you're doing chart patterns with an indicator, you've got everything right there, right? So at the start of a trade, you just got into a trade, you know where your stop is, you know where your take profit is, because you can see them on the screen, date, time, everything, what's going on in the market. You've got the price action. Trust me, they say, what do they say? A picture is worth 1,000 words. In this case, a picture might be worth 1,000 or more bucks, right? Here's the thing I want you to do. Here's where the $10 comes in, right? So once you do that, you take the screenshot, drop it into like a PowerPoint or a Word document. You can even add a couple notes to it. Most charts let you annotate, do whatever. Again, this shouldn't be something that takes you 97 minutes to do. I'm telling you something that should take you about 15 seconds, maybe a little bit longer if you want to do notes, right? So Control Alt plus print screen. That's on a Windows. I'm not sure about a Mac. You'd have to. I don't know that many people that trade on Mac, so you might have to do a search on that. But it's something pretty similar. I know it's an easy process, right? But drop it into something like a PowerPoint or Word document. Now the next step, right? I'm going to assume most people have a printer or access to a printer. So if you don't, it might be more than $10. If you don't have a printer, go out and get one. So $10, buy some paper, a 3-hole punch, and a binder. And what I want you to do is at the end of each trading day, you're going to print out whatever trades you made. Now you might have some more, maybe trades, or maybe you do have a trade that lasts a couple of days. During the trade, you want to take some screenshots, but at least at a minimum, take a shot of what's going on when you enter the trade and at the end of the trade. This is particularly important on a loss perspective, right? You just paid that. That's your tuition. Learn something from it. This will do a couple of things by keeping them in a binder. One, if you never print them out, you'll never go back to them. Promise you that. You will never go back to them. It's very important to have them printed out. A personal example here, this was in 2006. I started tracking my currency trades. I was learning to trade these patterns. And I was using basic chart patterns with fib levels. And I was able to go back after about 6 months, and I was able to look at all my losing trades. I actually set them all out, right? And because I was able to set them all out, this never would have happened if I wouldn't have been able to print them out. I could set them all out, and all of a sudden a pattern emerged, a pattern that was within me. Oftentimes, you know, for trading technicals, we think that the market patterns are the most important. It's the pattern within ourselves that is absolutely the most important. And what I saw was one key flaw in my losing trades, where actually 30% of them, if I had actually placed my stop by these patterns, particularly a few ticks back, just a few, I could have saved 30% of my losses. That's pretty big. I was down in Fort Worth doing a presentation last spring, and I was talking to a guy who just recently retired. He's in his mid-50s. He worked for, it was a logistics company, did pretty well. Actually, it was a freight company, not necessarily logistics, but it was a freight company. And he had hurt his back at work. And but he'd always wanted to be a trader. His wife took $10,000 out of her 401k to fund his first trading account, and he started off doing really well. And he was doing well, and he was doing well for a few months, and then all of a sudden the market started turning against him. And all of a sudden he got to a level where he just had to stop, right? He had lost a couple $1,000s, and we're going to talk about the importance of this in a minute, but he did a couple things right. One thing he'd been doing is taking screenshots of all of his trades, and he'd been keeping them, kept them in a binder. And so what he did was he's like, I got to figure this out. He stopped trading. So that was the second thing he did right. First, he tracked all his trades visually. Then he stopped trading. He went to his dining room table. He's telling me the story. He went to his dining room table. He just laid them all out, and he literally looked at them day after day. And he's like, and all of a sudden something clicked. It was a revelation. And when I saw him last year, he had just retired. He had given his boss notice. Now, I'm not saying this is going to happen for everybody, but this is how you learn. If you can't actually visually see them, right, they kind of go away. We forget those. So print them out. He basically credits his being able to become a successful trader and trade full time to this one simple act of printing out all of his trades, looking at the losses, looking at what the difference is between trades that were profitable and trades that lost money, specifically the losses, a revelation hit, and that's what he credits for it. And I've heard that from other people. I don't think nearly enough people do this. I think it's so important. By the way, this will also help keep you on track when you're having those bad days. Remember, we talked about not chasing markets, not revenge trading. If you're having a bad day, maybe you've lost 4 or 5 trades in a row, step away. Go back and look. If you've been keeping track of these for a while, you're going to be able to go back and flip through your portfolio, and you can organize these however you want. Maybe it's by instrument, maybe it's by strategy. I'll let you do that organizational part, but you'll be able to go back and you'll be able to look, and you'll see strings where maybe you lost 6 or 7 trades in a row, and then all of a sudden maybe the next 8, 9, 10 were profitable. It'll help keep you on track by doing this. And I've just got a couple more slides here to go. Hopefully nobody's been asleep. Thankfully, I can't hear snoring on these because y'all are muted. But that last slide there, this slide, I should say, is one of the most important things you can do, guaranteed. All right, so this is another big one. They don't take the money or know when to pause. So, right, let's say you have starting capital of $10,000. When do you remove some money? When do you scale up? When do you stop trading and reevaluate? So, you know, basically, at X, I do X. This should be in your trading plan, by the way. A couple of things on this. So let me just give an example. Let's say you've got $10,000. And this is just a guideline. I'll let you make your own rules, but have something similar. Let's say you've got $10,000 and it goes to 15, right? What do? You might want to put a rule in that if you get up to 15,000 or more, take 2,500 out. Make it real. It's not yours till you take it from the market. Maybe at that point, maybe if at 10,000, then you've gone to 15, you take out 2,500, you're at 12.5. Depending on the market you're trading, you might be able to scale up to 1 more contract. One thing I'll say about scaling up is always scale up in ones, right? Don't go from 1 to 5 to 10 to 18, scale up in ones. Do it based on a plan, a methodology, and I would say doing something like that. Starting capital 10,000 gets to 15, take 2,500, scale up one contract. Build it up to, let's say you build it up to 20,000, take out $3,000, you now got 17, maybe you scale up one more contract. Whatever you do, scale up in one lots and have a plan for taking money. On the other side, if you start out with 10,000 and you drop to 7,500, you might want to consider stop trading. Maybe it's at 8,000 you want to stop trading. A friend of mine used to own a really big brokerage firm, and he had this theory, and I've seen it proven that once somebody loses 50% of their account, and it almost doesn't matter how much, that's the magic number. If you lose 50% of your account, within the next few days, if you don't step away, you'll lose all of your money. It's a psychological switch or something. I don't know what the magic is behind it, but I've seen it in real life more times than I care to count. As I mentioned, the trader who had told me the story that he had just retired and how he retired, that was the one thing he did right. He stopped trading to reevaluate, right? How do you reevaluate? Well, hopefully, if you watched the slide before, you're taking screenshots and you're tracking all your trades and how they perform, right? Quick story, and then I'm going to share a couple of resources with you. Hopefully, this has been pretty enjoyable for you. But I was a broker, and I had a guy open up an account with me. This was in the currency markets. This was when I believe it was still 100 to 1 leverage, was pretty standard at that time, which is a lot. Put $5,000 in his account. This is on a Wednesday. Put $5,000 in his account. Talking to him about the platform, trading. He seemed pretty knowledgeable, like he had dabbled in trading a little bit. Talked to him about risk. The standard rule of thumb was you could trade one mini Forex contract for every $1,000 you had in your account. So he's like, okay, yeah, I won't trade any more than 5. And we talked about risk. Got him going. The next day I walk in, his account is like at $18,000. I'm like, whoa, that's pretty crazy. Walk in the next day, one of the guys that sits next to me, he's like, hey, have you seen this guy's account? And I'm like, oh no, and at first I was thinking, oh geez, he blew it up. No, it was like at 60 or 70,000. So the following Tuesday, so that was Thursday, Friday, Monday, he made a lot more. On Tuesday afternoon, his $5,000 account has become $185,000. He's gone from trading 5 mini contracts to trading over 100 standard contracts at a clip. That's crazy. Moving that risk. So he calls me up and he's like, hey, Dan, I'd like to take $50,000 out of my account. I said, that's a great idea. He's like, why don't you take 150,000 out? Look at what you did with 5. It's like, you've had a great run, but let's take it for what it is. The size you're trading now, it can move pretty fast. And he's like, oh yeah. I was like, great. All I need is an email from you telling me that you want to, I'll wire the funds back to you. And he's like, oh yeah, just got a couple of questions. And for some reason, I got a sinking feeling in my gut. And I was like, okay, but first send me the email. I know that you're in front of your computer because I can see that you're logged into your platform. And he's like, oh yeah, just a couple of questions. And so I was like, no, send me the email. And it was persistent on the question. So I was like, all right. So I answered his couple of questions. And I was like, all right, now send me that email. I want to confirm to you on this recorded line that I received it, right? And I can get that wire out this afternoon. Take the money. And he's like, oh yeah, I will. He's like, oh, somebody's at the door. I got to go. And I was like, no, damn it, send me that email. He's like, oh, it's my brother. I got to go talk. And I was like, no, send me the email. And he's like, I will in a bit. Well, he never sent me an email. I sent him one about 10 o'clock that night confirming that I had never received anything from him. And the next day I walk in and his account was from 185,000 down to 18,500. Now, if you think about it, and then before I let him hang up, one of his questions was about fundamentals, and I let him know that the following day was a Fed funds rate decision, and that I couldn't tell him what to do, but at 1:15 Central, he was on Central Time, 1:15 Central, he would probably want to be flat, particularly if he was trading in 100-lot clips. So he's like, oh yeah, I will not be trading at all over that time period. And I was like, okay, great. So I walk in the next day, he's at 18,500, never took any money out, and still not a bad week, right? If you consider it. Put in 5,000, he's at 360% gain, 18,500. And I'm like, but you can imagine, he's on tilt, to use a pinball term. And sure enough, about 1:14 and 58 seconds, my order monitor is lit up with his name. His 18,500 becomes $400 in a matter of about a minute and a half. And I was like, oh, really actually devastated for him. Didn't know him that well. I'd only known him a week. But oddest thing, I got an email About 15 minutes later, I knew I had to give him a call, but I was going to let him, catch his breath, take his fist out of the wall, do what he needed to do, and sends me an email. And it was so odd because, and I remember to this day, it was, "Hey Dan, don't know if you saw my account, but the Aussie dollar really kicked my ass last night." "Oh well, easy come, easy go. How do I put more money in my account?" So at this point, I'm thinking, okay, this guy is. Oh, did I just see a? Oh, did we lose the sound? I'm still showing that it's coming across.
I'm still hearing you.
Oh, okay. Uh, so, and he basically says, "How do I put more money in my account?" He tries to do an electronic check for $1,000 and it bounces. Right? He had not life-changing money the day before, but certainly what most people would consider a hefty sum, particularly for a week's worth of work, and lost it all. And he never took any money out. Right? Now that's devastation. I've just seen people do it over and over again, where they're trading and they don't have a plan. Put this in your trading plan. When you're trying to scale up, have a place where if you're making money, you take some out and have a method for scaling up. On the opposite side, have a place where you stop trading. So real quick, I'm going to show you some resources because I wouldn't be doing my other job if I didn't. If you're not familiar with Nadex, go to nadex.com and check us out. Open a demo account. We've got 3 different contract types. If you're more of a futures trader, I encourage you to check out our what we call our touch brackets. They're actually a contract that has a floor and a ceiling, so you know your defined risk as well as a natural profit target. We've got these on 8 different markets right now, 4 indices. So the E-mini S&P, Dow, NASDAQ, Russell, as well as 4 major currency pairs. We're going to be expanding that as well. I just love your feedback. The demo account's free. It'll take you about 30 seconds. It is a lifetime demo account. In full disclosure, I say lifetime, but I think if you apply today, it'll expire in the year 2057. But if you need an extension at that point, go to it. By the way, we are an exchange. We're designed for the individuals as opposed to institutions. We don't have brokers. Nobody's going to call you up and hound you about funding. I don't care if you ever open up a live account. If you do, great. We're here to help and support and be with you all the way there. But definitely first step, open up a demo account. And then on our website, underneath Learning Center, there's a drop-down, educational courses, webinars, boom. And we're pretty soon going to have an Ask Me Anything on, it's actually my fault. We should have had it already. I owe Mike and Terry some additional information for that, which I'll be getting over hopefully tomorrow once it's all through compliance. And we'll have an Ask Me Anything page up and running. In the meantime, though, got a question about Nadex? This is a great forum on Futures.io. I encourage you to use it and take full advantage. I mean, that's why we're here. And lastly, I'm going to turn it over. So any questions, go ahead and fire away. And by the way, if you need to contact me, there's my email, as well as how to get a hold of our customer service and our website. Hopefully it wasn't too boring, and hopefully, even if, like I said at the beginning, if you took away a couple of bits that you find helpful, then I consider my job done.
All right, feel free to start typing your questions in, and I'll ask them to Dan. Do you work with multi-charts, and also on stemming on that, how does a charting work with Nadex?
So right now, as far as the charts, our platform is proprietary, so it's proprietary to Nadex. So you won't find it on a multi-charts, which, by the way, is a platform that I love. What we are working on, though, we are actually redesigning our entire platform and trading experience, which I've been on that team, and we've been doing that for quite a few months now. When we launch that, one of the plans that I have in place is to actually be able to utilize, because we have a basic charting package. By the way, there's no cost for the data. It is free for the Nadex indicative data, which is the underlying market data that we provide. My goal, though, and a long way to answer this question instead of just saying no, is that for firms like multi-charts and that have really cool charting packages, that's what they do best. I work for an exchange, Nadex. We're here to match buyers and sellers, and we have what will be, it's already a decent platform, but it'll be substantially better with a decent charting package. I'd like to integrate with firms like multi-charts and some others to be able to offer those for Nadex products, because when you're trading Nadex, the analysis should really still be done on the underlying market, because that's what's going to move the price of our contract. So we don't yet. but I'm hoping in the next 5 or 6 months, we should.
Okay. Um, does Nadex serve all markets? Example, forex or futures, etc.
Yeah, so Nadex is regulated by the CFTC, Commodity Futures Trading Commission. So our contracts are based on futures, so futures like at the CME, so stock index futures, U.S. stock index futures, as well as some international commodities like gold and oil, silver, copper, natty gas, a couple of ags. To be honest, the agricultural products don't get a ton of traction. And then the major currency pairs plus some yen crosses. We do have 3 contract types. We offer what we're best known for as a binary option, which if you're looking for something that offers a lot of volatility, very short-term trade, binary options are probably the way to go. I think there's a lot of cool strategies for those, particularly around, like for instance, when I was trading currencies, I would never trade around like a non-farm payroll or a Fed decision, right? It's just too risky. But in those situations, there's some great strategies on binary options, utilizing like a strangle. We have touch brackets, which are very linear to the underlying markets. They've got a floor and a ceiling. They pretty much move tick for tick with the futures markets and currency markets, but they've got a maximum, think of it almost like a guaranteed stop, right? You know what your maximum loss is going in, and you also have a natural profit target. Of course, you can close the trade early, right? You don't have to take the maximums. And then we have a call spread contract, which introduces optionality. So actually a great way to learn. It's basically a traditional options spread, just packaged as a single unit. If you're interested in options, the call spread is a great way to start learning some of the basic functions of how options work and how these spreads work.
Okay. If I take a trade, who or what is on the other side of that trade with Nadex?
So Nadex being an exchange, one, we are never on the other side. We have no interest in the outcome. So being an exchange, we do have third-party market makers, which are typically institutional firms, which are there to provide quotes for our markets. So it's typically, in most cases, it will be a market maker because they're providing all the liquidity to the exchange, or it could be another member. It could be Joe Smith in Wyoming, who somehow matched against Wendy Smith, who's a waitress in New York, right? Because as an exchange, you don't have to take whatever the bid or offer is, right? That's there, right? If you want to, if you just want to take it, but you can work your own price as well, and then you'll go to the top of the book. One thing I do want to mention, because we are designed for individual traders. So if you go to most markets, right, that are designed for institutions, larger contract sizes, requires deep pockets. You have a lot of huge institutions battling back and forth, high frequency trading. At Nadex, our market makers provide liquidity, meaning they provide quotes, right? They're there so that if you want to place a trade on something, you've got a market to do that. What they're not allowed to do, though, is actually place orders, which is very unique to Nadex. So by that, they provide quotes, so they provide liquidity. They're liquidity providers, they're market makers, they're never market takers. So they can't just sweep the book, right? So our whole goal is to keep a fair level playing field at Nadex.
Okay. I don't see any other questions at the moment. I'll give them another minute or so.
Okay.
If you're watching this video later and you have a question, you see Dan's email on the screen or the customer service email. Please feel free to contact them with whatever questions you have about Nadex. All right, I think that is it. Thank you for the webinar, for spending some time with us this evening, and for the information.
Thank you very much, Terry. I hope you have a great evening.
Absolutely.
Thank you, everyone.